For decades, Japan has been the silent dragon of the global economy. Trapped in the grip of deflation and stagnation, its central bank, BOJ, orchestrated an unprecedented monetary policy, negative interest rates, yield curve control, and massive asset purchases that made it the largest holder of its own debt and a quiet colossus in global markets. Japan became the world's largest buyer of debt, an anchor of stability absorbing bonds from the United States, Europe, and other nations, thereby keeping global borrowing costs low. To better understand with a simple example, imagine Japan was like a child with a huge savings box. For a very long time, because its money wasn't earning much inside its own country, it started putting its money into the savings boxes of other big kids, like the kid from the United States and the kids from Europe. It would tell them, "Here's some of my money, please give it back to me later with a little bit extra." This was good for the United States and Europe, because they had plenty of money to use and do things, and they didn't have to pay much extra back to Japan. But the tide has turned. Global inflation, driven by supply chain disruptions, the war in Ukraine, and a post-pandemic demand surge, has finally reached Japan's shores. It's no longer a gentle breeze, but a strong wind shaking the foundations of its monetary policy. The BOJ, under immense pressure, is forced to consider the unthinkable, normalizing its monetary policy and, potentially, raising interest rates. This is where the real ripple effect begins. The turn of the helm. Will Japan sell its global debt? The most direct and dramatic implication of a shift in the BOJ's policy is the potential sale of the massive portfolio of foreign bonds that Japan has accumulated over the years. Pension funds, insurance companies, and the BOJ itself have been net buyers of US and European debt, seeking higher yields than those offered by their domestic market. If rates in Japan rise, the attractiveness of those foreign bonds diminishes, and the incentive to repatriate capital becomes irresistible. In other words, let's imagine this example. Remember how Japan had a huge amount of money put into the savings boxes of the United States and Europe? Well, if Japan's money wizard, the BOJ, makes money more expensive at home, Japan's investors, people who have money and invest it, will think, "Hey, now I can earn more money if I put it in my own savings box in Japan. I'm going to take my money out of the US and European savings boxes and bring it back home." This is like the kid from Japan starting to tell the kids from the US and Europe, "Give me back my money, I want it in my own savings box." And Japan begins to sell those money promises, bonds, it held from the United States and Europe. The pros for Japan. Strengthening of the yen. A rate hike would cause the yen to appreciate, making imports cheaper, crucial for a country that imports energy and food, and easing domestic inflationary pressure. To put it in easier terms to visualize, example, imagine the yen is like a superhero getting stronger. If the yen is strong, when Japan buys toys or food from other countries, it costs less. It's like getting a discount. This helps keep prices in Japanese stores from going up too much. Domestic profitability. Japanese investors would find attractive returns at home, incentivizing domestic investment. Economic normalization. It would be a step towards a more normal economy, with interest rates that better reflect growth and inflation. Greater fiscal flexibility. It would reduce reliance on the BOJ's printing press to finance the debt, giving the government more room to maneuver. The cons for Japan. Recession risk. A sharp rate hike could choke Japan's already weak economic recovery, increasing borrowing costs for businesses and consumers. Let's look at it with a simple analogy. Example, if money suddenly becomes very expensive, people and businesses might stop borrowing to do things. This could make Japan's economy slow down, like a car going very slowly. Cost of public debt. With the world's largest public debt, over 250% of GDP, even a small increase in interest rates would skyrocket the cost of servicing that debt for the Japanese government, potentially leading to a fiscal crisis. If we explain it like a children's story, example, the Japanese government has so many money promise papers that it owes. If money becomes more expensive, it will cost them much more to pay back all that money. It's like the Japanese kid, who already has a very heavy backpack full of debt papers, is suddenly told they have to pay more for each paper. Domestic financial shock. Japanese banks and insurers holding long-duration bonds would see their value fall, with potential implications for their solvency. Disincentive to export. A strong yen would hurt Japanese exporters, a key driver of the economy. For a more accessible perspective, example, if the yen becomes very strong, when Japan sells its cars or robots to other countries, they will be more expensive for the buyers. This could mean Japan sells fewer toys and cars. The financial tsunami, repercussions in the United States and Europe. This is where the story goes global. For the United States. The cons. Rising Treasury bond yields. If Japan, the largest foreign holder of U.S. debt, begins to sell Treasury bonds, the supply in the market will increase. This, combined with lower Japanese demand, would push up U.S. bond yields. Let's pause for a practical example. When Japan takes its money out of the U.S. savings box, there's less money available for the United States to borrow. It's like the baker having less bread to sell. When there's less, the bread becomes more expensive. So, the U.S. government, businesses, and families will have to pay more to borrow money, to build houses, cars, etc. Higher borrowing costs. Rising Treasury yields would translate into higher borrowing costs for the heavily indebted U.S. government, businesses, and consumers, mortgages, car loans. Impact on the Fed. The Federal Reserve, already battling inflation, would find an unexpected ally in tightening financial conditions, or a rival if the market reacts disorderly. It could complicate its own monetary tightening strategy. Capital outflows. A massive repatriation of Japanese capital could weaken the dollar against the yen, although in a context of overall dollar strength, the impact might be nuanced. The pros, less obvious and more contextual. Lower imported inflation. If the yen strengthens and Japanese imports become more expensive for the US, there could be a marginal disinflationary effect on some goods. Global normalization signals. For advocates of free markets, the normalization of Japanese monetary policy could be seen as a positive step towards a more balanced global financial system. For Europe. The cons. Pressure on European bonds. Similar to the US, Japanese investors are significant buyers of Eurozone bonds and those of some member countries. A sale by Japan would exert upward pressure on European bond yields. To simplify the concept, example, the same as for the United States. If Japan takes its money out of the savings boxes of European countries, money to borrow becomes more expensive. This is very difficult for European countries that already have many money promise papers that they owe, like Spain, Italy, or France. They will have to pay much more to pay back that money. Exacerbation of debt problems. For Eurozone countries with high debt levels, Italy, Spain, France, rising yields would make their debt burden even more unsustainable, increasing the risk of a sovereign debt crisis. Impact on the ECB. The European Central Bank, ECB, also in a tightening cycle, could see its efforts counteracted or magnified by the outflow of Japanese capital, making its job more difficult. Weakening of the euro. The sale of European assets by Japan could contribute to further euro weakness against other currencies. Eurozone fragmentation. If yield spreads between Eurozone countries widen sharply, the cohesion of the monetary union could be threatened. The pros, very limited and with high risks. Export competitiveness. A weaker euro, resulting from Japanese selling, could, in theory, make European exports more competitive. However, this benefit would be easily overshadowed by the costs of increased debt and financial instability. Conclusion. The perfect storm or the necessary readjustment. Japan's decision to abandon its decades of ultra-loose monetary policy is not just an economic event, it is a geopolitical financial earthquake. The sale of its vast holdings of global debt, particularly U.S. Treasury bonds and European bonds, threatens to destabilize already fragile markets, dramatically raise borrowing costs for major global economies, and exacerbate inflationary or recessionary pressures. Let's imagine the situation this way. Example. So, the country of Japan, which for a long time was the child putting its money into everyone else's savings boxes, is now thinking about bringing its money back home because it's starting to be worth more there too. This is like a big game changer in our magical world. If Japan does this very slowly and carefully, perhaps it will be a change that helps the world adjust and prices become more normal. But if Japan does it very quickly, and suddenly pulls a lot of money out of the US and European savings boxes, it would be like a big money earthquake. It would make money to borrow extremely expensive worldwide, and could make the economies of the US and Europe sick or very, very slow. It would be a story with a somewhat scary ending, at least at first. The silent dragon is awakening, and its roar will not only echo in Tokyo but will send shockwaves that will redefine the monetary and fiscal landscape of the United States and Europe. The question is not whether there will be an impact, but how violent this adjustment will be, and whether global economies are prepared for the decompression of one of the largest capital anchors the world has ever known. The era of cheap money, sustained in part by Japan's unique policy, could be coming to an abrupt and noisy end. If you enjoyed this video, hit the like button, subscribe to the channel, and turn on the notification bell so you don't miss any of our upcoming content. Share this video so more people can enjoy it. I'm Juan Blisa, and everything shared here is the result of meticulous research, verified through reliable and internationally recognized economic and geopolitical sources. Thank you for your support,